Good morning, everyone, and welcome to the Fortress financial results presentation for the financial year ended 30 June 2020. It's been 6 months since we last presented our interim results, but it might as well have been 6 years. It's such a different world at the moment. But welcome. We'll hopefully have your attention for about an hour as we go through our portfolio overview. Ian Forster, our FD, will take you through some of the financial performance, and Vuso Majiji, our retail director, will take you through some of the highlights of the retail portfolio. It has been a very trying time for the whole of Fortress, for our staff, and I think I'd like to just say a big thank you to them. It's been incredible to see, how everybody's worked remotely and actually all come together to manage the business and in particular the finance team to actually get these results done in the middle of a lockdown and trying to do audits remotely and things like that. So well done, and thanks to the board for all their support and the endless Teams and Zoom meetings that I know we're all quite tired of. This is a slide up on the screen, just an overview of where we are. We have presented it a few times, and I think we'll leave it in the presentation just to kind of track where we are and where we want to go. Our LTV, if you look in the middle of that left-hand block, 38.5, we had targeted 30 to 35, so that is a little bit higher. It's really driven by the Nepi Rockcastle decline in the share price. We still have the non-core assets. Pleasingly, during the year, we disposed of about 2.3 billion of assets that this time last year we had identified as non-core. So we still have the offices and the land, the office land and the SA direct industrial, and some small other properties, a hotel and some motor dealerships. And really, if you look to the circle on the right, what we're looking to do is to dispose of that non-core, and as we've said, recycle that into the top structures for our logistics portfolio. That'll take the logistics to round about 16 billion. Our SA direct retail, which in this little crisis we've had has really proved very defensive, of 10 billion. Our shares in Nepi Rockcastle of 23.3% of that business. And then we had previously said 3 to 4 billion new acquisitions, but I think given the rise in LTV, we've said debt reduction and possibly some opportunistic acquisitions if the opportunities present itself. Asset disposals, development pipeline, and our core asset performance, those are sort of three of the key strategic areas which we focused on. We disposed of 877 million rand of property during the financial year. Unfortunately, the deeds office, when the lockdown occurred towards the end of March, completely closed and is still really on a bit of a go slow. It's open one day, closed the next. So we're struggling to transfer those held for sale properties. But if we include the two, and we're very confident that the held for sale will be transferred, we actually do get to the target that we set ourselves for the year of 1.2 billion rand of asset sales. And as I mentioned, the non-core disposals, which includes the disposal of our shares in Resilient, largely by way of the dividend, the scrip dividend that we paid out at interims, 2.3 billion. So something else that I think it does add excitement to the business. Our development pipeline currently in the ground on a total basis, so this is the developments that we control, not our effective share, 172,000 squares. Our incremental capex in terms of cost to complete that from 1 July, 675 million. I'll touch on that a little bit later. And we still are seeing a lot of interest in our development pipeline in high quality logistics, especially given the pandemic. We had a lot of overflow space. We had a lot of e-commerce inquiries. So I think it is still something that I think globally is quite an exciting asset class. So we're very comfortable with that positioning and that strategy. In terms of our core asset performance, it really was all driven by the last quarter of the financial year. We gave tenant relief of about 143 million rand. That was roughly a 60-40 split, 60% discounts, and that was mostly in the retail portfolio, and 40% in terms of deferments. And I think in that you can tell where the stronger portfolios are and the slightly weaker ones. Our industrial portfolio, we wrote off 11 million, deferred about 14. and on 3.5 billion. So I think that does show you that there's a lot of weakness in that industrial portfolio. The load shedding over the last period and ongoing is really impacting those tenants. The logistics was not much in terms of write-off, 7 million, mostly deferrals, and offices was about 3 million in terms of the write-off and about 7 million in terms of the deferrals. Pleasingly, the logistics portfolio has actually had a record low for Fortress of 3%, so you can see that there's still good demand for that. And we just are now focusing on really tenant retention. When we look at the retentions versus new deals, it's far better to retain the tenant. So that's really a focus of ours. Just if you look on the right-hand side of the screen, under core asset performance, there's a picture of our Linbro freezer there that was let to Imperial during the year. We shifted that lease over to Vector, who bought Imperial Cold Logistics from Imperial Group. And if you just look at the bottom there, you'll see there's a little open site. That's actually the first acquisition we've done for a long time. We just acquired the site. Vector wanted to expand, so that was a pre-lease deal. But it's quite nice to see, companies expanding in this market of the quality of Vector. I think if we rewind to where we were in the hard lockdown, sort of during April, I think people were wondering what we were going to do with valuations. We did guesstimate they'd be sort of mid-single digits down, and I think globally we've seen a similar trend. So our like-for-like value decrease for the year was minus 4.7, and you can see there in terms of the different categories. Again, offices very weak. I think last year they were down about 7.7, down 8.6 this year, like-for-like. Industrial, and then holding up remarkably well, in my opinion, retail and logistics. And we've just put a value per square there, just to give you an indication. I think it's very reasonable. It's certainly below replacement cost for a lot of those assets. We left our valuers unchanged. We get 100% of our portfolio formally valued by independent valuers every year. So we don't, on the standing portfolio of income-producing assets, we don't do any directors' valuations. Discount rates didn't move much. I think there was a little bit of, kind of opinion from the valuers that given the lower interest rates, they didn't move the discount rates, but they did move quite a lot was the growth assumption and the exit cap rate. So it was largely those two factors in the DCF that led to the decline in value. And most of the valuers now are using a DCF. I think it's just one valuer who does a lot of our Durban portfolio who largely uses a cap rate. Just some interesting feedback that we are getting from our sales team. Still lots of demand for well-let, higher quality logistics assets, and actually smaller format retail, a classic sort of 8,000 square meter ShopRite Pick and Pay anchored asset. This is a video of Eastport Logistics Park. It's still really got a lot of interest here on the R21. I mean, as you head north on the R21, you go past Plumbago, where there's Takealot, DHL, Kune Nagel. You go past the new DSV super facility, and then you get to Eastport on the off-ramp. Savino took transfer of their building. As we said in the past, very sad to see it go, but it was at a 25% premium to cost, 7.4% forward yield. So we made some money there. Along the highway there, that one is pre-let to Clipper, 14,000 squares. They do have an option to acquire half. And then we've got two spec boxes on the go. There's still quite a lot of interest in Eastport. We own 65% of that park in an undivided share. Another interesting deal here is we've signed an offer to sell some land to a data center developer. It's land at the back, so it's not as prime as the highway frontage. It's actually there on the screen, just above where that truck is driving exceptionally fast now. Just on the right-hand side, the left-hand side now. So that's actually great. I hope we close it. It'll get some interest in the park, and I think we're also happy to chew through the land as quickly as we can. Just a few stats. The vacancy by GLA increased about 90 basis points from 8 to 8.9. I think it's actually very good. I think the asset management team did well. And if you look at vacancy by value, which is something that we've been putting in for the last 12 months, 5.7, only up, I think, about 10 basis points. It really shows that the weakness is in the lower quality, lower valued assets. In-force escalations are nice South African nuance to property, still 7.3, but unfortunately impacted by a lot of negative reversions, which we saw portfolio-wide at minus 4.2, and our lease expiry profile at 3.1 years. As I mentioned, the total vacancy by value, it was 5.8, then 5.6 at interims, 5.7 now. By GLA, you can see it rising, and if you look to the second piece on the right-hand side under industrial, you can really see that shooting up, and that is a cause for concern, and we'll touch on some of the asset management interventions that we're planning in the industrial portfolio. As we said, the offices have been sitting around that level. There are a large number of big offices, such as Oak Avenue and Centurion, which are vacant, so that number is high, but fortunately the office portfolio is sub 5% of our overall portfolio, and pleasingly logistics came down, retail kicked up due to the pandemic. Loladia Logistics Park, we will complete the last building in this park in about a month or two's time. That one that you can see in this video is not quite complete yet. We buy cars, we took transfer of their 50% under that option agreement at about a 1% compressed yield from our yield on cost. Goldwagen, similar thing, have exercised their option. They'll be taking transfer as soon as we can get the title deeds out of the deeds office and actually facilitate that transfer for 50% of that building. At the top of the screen, this is Vodacom, who moved in about a year ago, and then you can see the one that we're looking to complete there. We do still have an option on the south side of this park. It's sort of on the left-hand side now. In terms of just acquiring more land there, but we prefer not to land bank in this market, so we've got an option there. It's a great node. You can see the cars flying down the N1 there, going a bit too fast. It's a great site, fantastic visibility, and a really nice node. So we actually love these kind of parks. I think it's really been very successful. I'll hand you over now to our CFO, Ian Forster, who will take you through some of the financial performance.
Morning. Thanks, Steve. Appreciate it. As a result of the impact of COVID-19 on our standing portfolio and our investment in Nepi Rockcastle, Fortress will pay a distribution of 23 cents on the Fortress A share. And that's less than its entitlement of 76 cents for this period, which is on the back of an MOI amendment that was voted on and approved by shareholders in July earlier this year. In line with that MOI amendment and in line with the MOI, to the extent the A share entitlement is not met, the B share will not receive a dividend. The reference base for next year, 2021 H2, will then be 76.13 cents. On the next slide, we have how we make up our distributable income, and that's where we build up the income from the direct properties and make adjustments to it. We start with our NOI from our direct portfolio, 1.97 billion. This is down on last year, obviously as a result of COVID. Notable adjustments to that is the increase, the dividends we receive on our listed portfolio. That would have been income on our Nepi, Rockcastle and Resilient shares. We've included the cap issue that we will receive from Nepi, Rockcastle toward the end of this year, much the same as how we've historically treated scrip dividends. Just to note, we still have the interest, capitalized interest that was distributed in the first half of the financial period, being 164 million. We did communicate to shareholders that Fortress would be deviating somewhat from REIT best practice distribution methodology, in that we no longer distribute capitalized interest from H2 2020. So that's still the first half portion. At our interims, we also mentioned that we expected the interest rate protection costs to be much higher in the second half, and that's really as a result of significant interest rate protection that we took out earlier this year in the form of caps. They are quite expensive, but we certainly will see the benefit of those given the lower interest rate environment that we find ourselves in now. That gets us to a total of roughly 2.2 billion of distributable income. How have we distributed that? On next slide, we can see the first half distribution of 1.7 billion, 1.697 billion. That was paid by way of a distribution in specie. We distributed our resilient shares at an effective price of 52.69 Rand per share. The second half distribution of 23 cents per A share equates to 274 million. That will be paid in cash with a small amount retained by Fortress, giving us a total of 89% of our distributable income being distributed in the 2020 year. That equates or translates to approximately 76% of distributable profit as defined by the JSE's listing requirements. The reason for that difference is we obviously calculate our distributable income based on REIT best practice methodology, which is really forward-looking, or it employs a sort of a capital employed mindset to earnings, whilst the listing requirements really looks back and in line with the taxable income for the period. On the next slide, we can see our NAV bridge. We introduced a new metric at our interim presentation earlier this year of a NAV per equity share, and we've restated for June 2019. That's an amount of 16.07 Rand, reconciling down to 10.94 Rand. The big movers on this slide, as you can see, is some impairments taken in our direct property and development pipeline. Steve will speak to those later on in the presentation, and then the significant reduction in value or in respect of our Nepi Rockcastle share. We equity account Nepi Rock, and once the sort of IFRS adjustments are passed, we then effectively mark to market to the underlying price. So whilst its NAV would be, probably there would have been very little movement on that line if we were to consolidate that investment, we've had to take the impairments just given the IFRS accounting for it. Some marginal movements on cash and borrowings, giving us the 10.94 Rand closing balance. Liquidity and funding. As Steve's already alluded to, our LTV has moved out to 38.5%. That is marginally outside of our targeted range, the higher end being 35%. Again, on the back of that price adjustment on Nepi. Our interest cover ratio, looking back at the 2020 year, is 3 times. Our current available cash and facilities on hand, 2.8 billion. At year end, that was roughly 3. We have repaid subsequent to year-end an amount of 241 million in the debt capital markets, which I'll get to shortly. Fortress has re-entered the debt capital markets in the form of a public auction, which we haven't done in a number of years, and the intention was to sort of continue with that program, and of course COVID has an impact on that, and really we haven't really needed the cash right now, so we probably will be looking at that program in the coming months again. We refinanced approximately 1.15 billion during the hard lockdown, and that was coupled to the 4.5 billion that we referred to at our interim results, which was really a refinancing and tenor extension of amounts expiring in 2020 and 2021, which leaves us with very little to refinance, in fact, in 2021, and I'll get to that shortly. To bolster our liquidity and shore up the balance sheet, we entered into a collar on 11 million Nepi shares. We retained the dividends on those collared shares, and it gave us the ability to raise relatively cheap funding in the form of a 750 million rand loan at 4.3%. Cash collections, obviously very topical given COVID and where we find ourselves at the moment. For the second half of the financial year, that's Jan to June, cash collections were 96% of what was actually billed to tenants. 93% of that, during the months of the sort of hard lockdown and the softer lockdown, April through August, we collected 93% of what was actually billed. It's important to note of what was actually billed, because as we sort of worked through the lockdown, amounts that were negotiated, discounts and deferrals and so on, wouldn't have found their way into the actual billings. So this was against actual amounts billed to tenants. August approximates a pre-COVID sort of normal month, in which we collected 97%, and below shows the breakdown in which portfolio that 97% was collected. Another hot topic in my next slide is the cross-currency position to us and the sector. The economics of this product has changed significantly in the last 6 months. We used to achieve a spread of approximately 7.5%. This is reduced to 3.9%. And for the significant risk or liquidity risk the product introduces, we have decided to close it out, and we've effectively closed out all of our, or closed out or neutralized all of the the currency risk attached to the product from Jan to now at a rate of 18 Rand and 18 cents. I suppose what's important to note then is that our shareholders have a greater exposure to euro-based assets. Our interest rate hedging, total debt at 30 June, 16.6 billion. We adjust for some fixed rate debt to an adjusted floating rate debt balance of approximately 15.2 billion, of which we've hedged by way of swaps and caps 11.2 billion, a 73% hedged rate. If we look at the swaps and caps and the maturity profile of them and the weighting, it's important to note that we heavily weighted to caps, approximately sort of 55% caps versus swaps, and caps in the longer date periods being 2025 through to 2028, which along with the floating rate debt that we have exposure to will give us a nice saving in the interest line certainly in the coming years in this lower interest rate environment to the extent it remains. Our debt maturity profile, as I previously alluded to, we have very little to do in June 2021, only 1.1 billion. If we look at the portfolio book of circa 16 to 17 billion and tenors of between 3 and 5 years, you'd expect to see somewhere between 3 and 5 billion to expire on an annual basis. What we've also included there is the portion under our DMTN program that expires in June 2021. There's about 900 that expires in June 2023 and 500 in June 2025. Of the 1.15 billion in June 2021, I've already mentioned that we've already repaid 241 million of that. The next slide, we have our listed investments. We still hold, obviously, our NEPI position. We've increased the stake marginally, 10,000 shares in the current year. Resilient, we've effectively exited three quarters in our scrip dividend of the first half at a price of effectively 52.69 Rand, and the balance was sold in the market at around 40 Rand a share. So COVID has introduced some interesting accounting for us that we've had to do. As I mentioned previously, some of the discounts, etc., wouldn't have been billed or the deferrals not billed. Certainly the discounts, given an interpretation of our IFRS sort of revenue recognition standard, we've had to book the revenue and then subsequently provide for the write-off, which comes through on two different lines, obviously revenue and property expenses. the deferrals are caught in the straight lining adjustment, just given that the revenue still will come, but it's deferred over a period of time. Both of these amounts are excluded from our distributable income. I suppose the other side of that entry just being the write of taking in the property expenses with some additional repairs and maintenance and an increased soft costs as a result of COVID account for the majority of the increase in our direct property expense line. And that's it for me. I'm going to hand over to Steve.
Yeah, thanks very much, Ian. I'll just quickly take you through Cornubia. I think just something that's, a little bit of an update on this. It was where we developed the macro. We own 50.1% of a subsidiary company in which we did this development. We did provide funding to the subsidiary of 620 million. Cost to date's about 850. We did recognize a group impairment of roughly 72 million. If you include that, the loan to value on the loan we've provided is about 80%, and we're in the process of transferring it out in undivided shares and getting the cash back. That new box, 23,000 squares, very popular. I think, what the one nuance with the Durban market is there is sometimes a need to be able to split it up, so we can split this box up into 4, slightly smaller requirements than we see down south in around the port in Clearwood. And that macro, for the feedback, we don't get turnover numbers, but it's performing very well, and we've left a space between this box and the macro, and we're looking at potentially doing some more big box retail. If we can't get that going, then we'll just do another warehouse. I'll hand you over now to Vuso, who's going to take you through the retail performance.
Good morning, everyone. Thanks for joining us. Our portfolio hasn't changed much. We still have 59 buildings, although post year end, we have sold 2 buildings, Protea in Brixton and Town Talk in Groblersdal. We are waiting transfer of these. It should happen in the next couple of weeks. As Steve mentioned, our valuations came down by 3% on the retail portfolio. I think this was expected during the period of COVID, and also the valuers were are anticipating softer rentals in the year to come. So that's what led to the decrease there. We're still doing quite a lot of rental deals at the moment. We had about 449 leases that came up for renewal in the past year. We renewed about 80% of those, and we signed 98 new leases during the period. We're still getting good rental deals. I think the reason for that is because our cost to occupation is sitting at 6%. So we're not over-rented. Yes, our rentals did come down with a negative reversion of -1%, but I think that can be expected in this market. We're still doing still getting escalation rates of between 6 and 7%. However, tenants are pushing back towards 5.5, and we're still doing 3 to 5 year leases with national tenants. Our vacancies did go up in the period to 6%. Edgar's West Street, or the ex-Edgar's West Street building in Durban, is still our biggest vacancy at 10,000 squares. This building is on our sales list. We want to sell it. We had started a redevelopment there, but we delayed it because we are in discussions with several potential buyers, and most of them want to buy the building in its vacant state. We haven't concluded anything. We're still in talks, but in the meantime, what we have done is we have signed a lease with Clicks and Studio 88, and they'll take up some of the GLA. I think those leases, they'll start trading there before the year end. Hopefully we'll get to sell the building within the year or early next year. You would have seen that the EdCon business rescue process is proceeding well. We have reached agreement with the two purchasers of the Jet and the Edgar's business. We've agreed rental terms on 2 of the 3 Edgar's within our portfolio and 13 of the 16 Jets within the portfolio. Obviously, these deals are still subject to certain conditions which hopefully will get fulfilled shortly. What that does to our vacancies is that there's 2 leases that, 2 premises that have been handed back to us, Edgar's Everton and Jet Middelburg. We are talking to tenants on those, and hopefully we'll fill those before year end. I think during the COVID, after COVID started, we've had many discussions with tenants. The discussions have been constructive, and I think that they've been fair. We've concluded or agreed rental credits of about 63 million rands for this period. What that has done to our net income, net operating income, is that it's decreased it by 8%. Most of that sits in that number, in that 63.5 million. Over and above this 63.5 million, there is 3 million rands worth of rental deferments that we've also agreed with tenants. We've also seen our costs increase slightly because of COVID. We spent about 5 million rands on items that relate to the welfare of our staff and also the welfare of consumers at our centres. These include PPE, they include additional cleaners, additional security, and hand sanitizers. So it has been a little bit costly, but I think it was necessary to do that. I think trading conditions or the year can really be broken down into 2 halves. The period before COVID and the period during COVID. For the full year to 30 June, our sales contracted by 2.5%, but in the first 9 months, July to March, on a like-on-like basis, our sales were up 3%. And then you see that there's quite a sharp decline in April. Basically in April, our sales decreased to about 51% of the previous April's turnovers. We've since seen an improvement as the regulations have been relaxed gradually. You don't see it on the screen, but in July, we're back up to 97% of the previous year's trading figures. I think what we saw is that the retailers who were trading well pre-COVID are still trading well. In fact, they came out quite strongly from May. So grocers, pharmacies, pharmaceutical retailers, and hardware stores actually performed quite well. Pharmaceuticals in our portfolio are up 27%, and so are hardware stores. We also saw that apparel retailers that are focused on the value market are also performing very well post May of this year. If we look at our portfolio based on our various categories, we see that the CBDs and the townships were the poorer performers during this period. I think there's a number of reasons for that. In the CBD, we saw that restrictions on public transport affected our market quite a bit. And we also saw that the fact that people are working from home, or more people are working from home, impacted on those commuter markets. So if you look at one of our CBD shopping centers, for instance, Park Central, where we normally have about 1.2 million people per month, we are only back to just above 80% of the foot count at the moment. CBDs have been the slower ones to recover in our experience. And I think the reason for that is because people are still working from home. There has been some improvement in that. And if you look at townships, I think townships are down for several reasons. What we noticed in the period in the beginning of the lockdown, in fact just before the lockdown, in the more urban areas, a lot of people were doing stockpiling buying. In the township areas, that was slow, and I think the reason for that was because of the timing of month end. So what we saw immediately after lockdown was introduced, there were a lot of queues that were experienced in the townships. And the reason for that is obviously because there's more densely populated areas and because of social distancing measures that were implemented. So what happened there is that the queues actually discouraged some of the motorized customers, and they went to the nearby suburban centers. So we see this in particular in centers like Everton, which is in the south, and some of our centers in Tembisa and Crossroads in Gwamhlanga. I think that thread did carry on during lockdown. So because of the queues in townships, we've lost a little bit of the motorized customer, and we are left with the basket customer at the moment. What also happened in the townships is that Amagoduka, migrant workers, went home to the rural areas. That did help the performance of the rural areas, but it did harm townships. And obviously there are issues related to job losses and salary cuts as well. The rural markets performed relatively well. As I said, there were a lot more people coming from the more urban areas that went home to the rural areas. But also this market and the township market is also supported by the government's social grant system. You would have seen that there are temporary social grants increases during this period. That has helped quite a bit. But even within the rural areas, you can see that there is a preference at the moment for high street shops in the rural towns rather than malls. Again, it's due to the queuing. So that's what we're seeing there. So our centers perform very well. In fact, the Eastern Cape and the Northern KZN performed very well. Those areas in our portfolio were up by 6%. So centers like Sterkspruit, Nongoma, and Kokstad performed well for us. And then if you look at the suburban centers, those also performed relatively well. I think centers like White River, Arbor Crossing, Zanin Lifestyle, and Flamwood Walk performed well for us. And that's because of the convenience offering of the centers and the fact that they're all open centers, so it's easy to go in and out. So that worked out well for us. I think looking into the rest of 2020, I think the trading conditions are going to be tough. And I think that it's difficult to look at trends at the moment because the situation is quite fluid. I think you'll only really start seeing where the direction is going once people start returning to work and once you start getting a feel of what's going to happen with the employment and generally with the economy. So our focus at the moment and for the rest of the year, in fact, and for beyond, is going to be on tenant retention. I'll hand back over to Steve now. Thank you.
Yeah, thanks, Fusa. As you said, defensive portfolio, which is required in this kind of market. This is Clearwood Logistics Park. I mean, we've had a long history with this park. It has been a tough development. It's taken quite a long time, but if you look there now on the left-hand side, we've got Samar. You can see some of those piling rigs. The new buildings going on there, built by Wilson Bailey, just at the front. The new off-ramp is done. So we've largely got this park ready, and now it's just putting the top structures on. Unfortunately, given the softer rental, the length of time, the soil improvement cost, we have had to recognize a further impairment of 392 million, which includes the capitalized interest, which I think this time last year we did expect. Excluding that, it's about 250, 270 million. So those two pockets will be ready mid next year. An interesting deal that we've just signed, if you look up at the top of the screen there, I'll come to a site plan. We've just signed a deal for a cargo terminal operator, so they'll put a lot of containers on there. It's about 56,000 square meters. So we're looking to conclude a deal on that. I think it's, just at the top there you can see that container yard. I think here it's noted the site area is 67. I think the deal we're looking at about 56. So that really just does attach a rental to the land. There will be some hard stand improvements required. At the bottom of the screen near the M4, we've got Pocket 4A, Pocket 4B. Still a lot of interest in those two sites. I think it is a fantastic park. It's a great location in the Durban Basin. So, I think over the fullness of time, we're going to be pleased with this investment, but unfortunately, it just has taken a long time, and those soil improvements, if you want to do it properly, are enormously expensive. So, but those are largely done, so that cost is sunk, literally sunk in the ground. Our logistics portfolio, it is becoming a much bigger part of our life. If you look at our total logistics exposure, including the land, it's 42% of our assets, of our direct assets. I think the vacancies come down to 3%, which is pleasing. Like-for-like NOI growth only 0.8. There were some discounts given in this portfolio, about 7 million. I think that middle block there, reversions minus 7.2, that is a bit of a cause for concern, and what's driving that is we're still offering rentals at our new parks where we were 3 or 4 years ago. So we are almost capping our own product in terms of market rental growth, and that's really because construction cost has still stayed relatively static, which, if you look at the impairment on this land is unsurprising that we had to impair it by at least the capitalized interest. Lease expiry profile 3.7 years. As we sell the older and build the newer, we expect that to improve, and a building valuation per square of 7,600 Rand, still quite below replacement cost. Just a couple of key lettings that we've done. Console, I think we do feel for them in the lockdown. They couldn't turn their furnaces off, so they were producing a lot of bottles, needed a lot of overflow space, so we've let 40,000 square meters to them. At the top right-hand side, that's a picture of the Zest box that's coming up. It should be ready around about January next year. It's a pre-let deal. We also signed a lease at Ekwezi, 16,000 squares, with the guys doing a documentary series. And on the bottom right, there is N1 Business Park. We own 20% of that, where a deal was signed with Takealot. I think we have quality space, and as we see, the quality space is very easy to let. Although the rental growth is still quite soft, you can let it. We signed a deal with a retailer who wants to do some cell phone distribution out of one of our prime facilities in Longmeadow. DSV Pharma moved out, 17,000 squares. So I think that's very, very pleasing to know that there's still demand out there for quality logistics space. This is the pipeline. I think, I'm sure many of you would appreciate that when the hard lockdown hit and we needed to conserve cash and nobody knew what the future looked like and we were staring into the abyss, we had to then go and really assess what we could turn off in terms of liquidity and what we didn't have to. And we sat down and went through this with the development guys and with our board. And when we looked at it, from sort of the year end going forward, our pro rata share, that last column on the right, 675 million out of 1.4 billion of total cost. So it's less than half. So, what we looked at is we were halfway done with a lot of these developments. So pausing it really wasn't feasible. I think, it's very hard to let a building without a roof. So we decided, we've got the cash, let's rather finish this round of speculative developments and the 2 pre-lets, and then we'll reassess where the market is on an ongoing basis. So I think we feel comfortable that we can fund this round of development, 675 million rand, quite easily, and we're still getting a lot of interest and demand. I mean, Zest is pre-let, Clipper's 8.5% yield, Clipper is pre-let 9.4% yield, and we're getting close to closing a deal at Cornubia Ridge. As I've touched on a couple of times, really our approach to the pipeline, we're happy to do JVs, we're happy to sell the land as we have done in Eastport, do turnkey development. So, I think our approach is really one of a developer. Whatever is going to maximize our profit on our land holdings, we're happy to entertain. So this is I think, part of the disappointing part of our pipeline. We did have to recognize an impairment. A lot of that, as I mentioned, was Clearwood, but also a lot of that was our Sandton sites. We recognized a 270 million rand impairment on our site opposite the Sandton Gautrain, next to the Old Mutual new head office, and another for the year 104 million rand further down the road. It's a JV we've got with Barrow. We own 80% of that site on Rivonia Road, but we have actually signed a sale agreement on a portion of that. It's quite small, and that's currently under DD. So, yeah, I mean, it's, I think now our land has really been fair valued down to quite a low level, in my opinion. If we exclude the capitalized interest, which I think when we looked at that last year, we thought it's going to be capitalizing, coming back down, 595 million rand impairment on our land holding in total, excluding the capitalized interest. So that's a sort of, I guess, a real value write down from last year. The office portfolio, as we've said, office is still structurally oversupplied. If you just look at those pictures there, yes, we did choose the nice ones with the fever trees in front, but I think it is a really nice portfolio now. It's decentralized suburban offices. We can sectionalize them. I think companies, appreciate that they get their own standalone box. It's very easy for them to control. 1,000, 2,000 square meters, not dissimilar to the office park that we occupy here in Morningside, if you've ever come to visit us, or ever will be allowed to again, I hope so. So this, we've also written it down, as I mentioned, 7.7% last year, 8.6% this year. So, it has come down in value. It's only 5% of our assets, high vacancy, but, that building valuation, 11,000 rand a square meter, radically below replacement cost, probably about half. So I think it is, it is quite easy, hopefully, to sell these granular office assets to owner-occupiers and other private investors. If you look on the right-hand side there, Kildrummy, it's a great office park, but it has high vacancy. And then below that, Wedgwood, which is actually full for the first time. That's pretty much opposite Nickel Way, if you know Johannesburg. And it's also, it's just a great node, but the rentals are under pressure. So again, we're looking to asset manage and sell. The industrial portfolio, as I mentioned, really a huge shoot up in vacancy, which has led to that like-for-like NOI growth of -15, because you've got a lot more vacancy. These are big buildings, and when they're vacant, they suck up a lot more cost. You have to put security in place. Unfortunately, the environment that we're in, if you have these big boxes with no security, takes a day or two, and then all the wiring's stripped, and they start to strip all the metal out. So, the vacancy does lead to quite a high negative yield, unfortunately, in this portfolio. But, again, 4,700 rand a square, we think we can sell it. This is something that we've done with InnoSpace, which we quite like, on 50 Electron, bit of a problem asset for us. It used to be Barloworld Logistics, but awkward, huge office. It's actually on the way to the airport in Johannesburg. But really nice concept, so I think we're going to do a lot more of these in terms of breaking up the space, getting it, attracting a different type of tenant and increasing the rental. And then also looking at sectionalizing our industrial mini parks and trying to sell those off on a sectional title basis. Property disposals for the year, pleasingly, quite a nice premium to book, 877 million. As you can see there, the smaller assets actually 50 million, 50 to 100, quite easy to sell, quite a lot, a much bigger market than, assets that have got a much bigger price tag. These are our held for sales. Hopefully, we've transferred Broad & Simmons. I think Protea, which was a retail center, which was actually a deal closed in lockdown, should transfer in the next day or so, pending the deeds office. I don't think we can, not say something about our share in Nepi Rockcastle. It's a huge part of our asset base. It's a really, really great company. I think their results were excellent. We were very pleased to see that office sale go through, which reduced their loan to value to 33%. They're now very liquid, very, very strong balance sheet. I mean, I would almost say a fortress type balance sheet. Maybe that's the wrong term. Green bond issuance of 500 million euro bond in July. I mean, it really is, still a great business. I think as Ian touched on, we did do a collar, but that was really just because we didn't want to sell it, and we just needed to, we felt that given the uncertainty during the lockdown in April and May, that we should probably just take some proactive steps to shore up liquidity for the balance sheet in the event that the lockdown took longer. I think at that stage nobody knew when it was really going to end. Environmental, social and governance, just a few highlights there. Our solar rollout is really going well. I mean, as we touched on load shedding and things like that. So it is exciting. We've actually increased our solar output year on year from 2019 to 2020 by 5 times, a 500% increase in the amount of solar we produced. I mean, it's, it was off quite a low base, but I think, we're adding about another 13 solar projects at the moment. So really going flat out with that. The economics make sense. Not quite there with the full battery backup. And as we've seen, we've had some learnings. For example, we buy cars, we added too much solar and it's now a waste. It's producing more than the guys need because we can't feed it in. So we're looking at seeing how on our logistics parks we can maybe cross over the urban lines and things like that. It gets a bit complicated from a regulatory perspective. We've also put smart water meters. We're rolling those out. We've got it on a few of our retail assets where we've got boreholes so we can track things, and it's amazing to see how quickly we pick up leaks. So I think it's also a great system for our tenants who are now, who pick up the cost if there's a tap left on. On social, BE, we were level 9 last year. We are compliant. We're just waiting for our rating to come in. We are hoping that it's better than level 8. We certainly are expecting that. Great partnership with Food and Trees for Africa. It's really one of our favorite charities to support, and it also unlocks a lot of community involvement at our retail assets. And we're supporting a number of CSI initiatives, and pleasingly, the board, non-execs and execs did listen to President Ramaphosa, and also gave about a month's worth of salary on both sides, salary and fees in terms of donations during the lockdown. On the governance side, I'd really like to thank Dr. Rajabedian. He's been a really steady hand at the helm of the board over a challenging couple of years. He stepped down at the end of June and is replaced by Robin Lockhart-Ross, who has been a non-executive for just over 2 years. Highly capable, very enthusiastic chair. So I think I'm looking forward to the future with Robin. Also joined our board, Ina Lopian, who is MD of Wakile's SA business, immense property experience, and in particular in retail and in our kind of retail. So she's on the investment committee, which is also exciting for us. And we bid farewell to Barnes van der Walt, who's been a long-standing board member. He was at Capital and then Fortress, chair of the investment committee. He's now really, really retired down on the South Coast. And Bongiwe Njobe, who does have another full-time role, and I think you'll appreciate balancing the two, sometimes quite challenging. And Mark Stevens stepped down, as we announced, around about this time last year. There is a process just to streamline the board committees and just get things more efficient, make sure there's not overlap and slightly more effective. So we'll update the market in due course. Guidance and prospects, unfortunately, we weren't in a position to really provide certain guidance. I think it's still quite fluid in terms of the lockdown. We are still under lockdown level 2. What's happening with Nepi, they only guided till the end of the year. So we will, as things progress and when we feel more confident in putting out guidance, we will do so. I guess prospects for Fortress, I think we're in an extremely comfortable position with our balance sheet. We've made a lot of hard decisions, closing the cross-currency swaps, shoring up the balance sheet, paying out the dividend in interims in the form of resilient shares. But I think that's really made us defensive, and I think we are now in a very comfortable position, happy to pay the dividend, albeit at the minimum level for JSE requirements. This is the last one. Just quickly another video while you all have your feet up at home in your lazy boy chairs. Long Lake Logistics Park. So you can see, actually, that's our one in the background. It goes quite quickly. So that's the small one in the front, and that's actually our site on the left. And Linbro Logistics, you can see the one, the big roof in the back, that's ours. It's literally the extension of Marlborough Drive. I think it's a great location. It's very convenient, and well done to M&T who bought it from Zendai. Have made a really nice node. If you look down on the right there, you'll see the Modderfontein Dam. There's a nice, I think they moved the Fourways farmers market there. It's actually a really nice node, and there's lots of developments. I think that's a Zenprop one on the right-hand side there. So it's a great logistics node. The K113 here is going to go all the way through Midrand to the N1. So it's very convenient, and that one is pre-let. So I think this is another node. The site on the right-hand side, as you look slightly up the hill, is also ours. So we'll develop that. We'll develop that in time. And lots of interest. I think the 12,000 not let yet, but we've taken a few potential users out there. I think that is quite a popular size, so I'm pretty sure we'll let that. That's Long Lake. These are the portfolio stats as at June 2020, and we'll take some questions now, if there are any.
Yes, sure. Ladies and gentlemen, thank you for dialing in this morning. This is just a reminder to ask any questions in the questions box provided below on the webcast. We do have a few questions, and just to highlight, of course, some of the information hasn't been provided or is confidential for reasons, so there are going to be times we can't answer it, but we do have a few questions here. Steve, you make comment that it is prudent to declare a reduced dividend during COVID. Would it not be even more prudent to declare no dividend at all? How does this work with the minimum requirements of remaining an SA REIT?
Yeah, thanks, Howie. So we didn't have that as an option. The JSE listings requirements still requires you to pay out 75% of your distributable profit, which is per the listings requirement calculation. Otherwise, you do lose your REIT status, unless you aren't solvent or liquid, which we clearly are. So we had to pay out at least 75% of our JSE distributable profit, which we've done.
And you also made a comment in the presentation that you, of course, need to maintain the REIT status. Are there any long-term costs associated with maintaining this REIT status? And if so, what are these costs?
I don't think so. I mean, I think if we weren't a REIT, I think it would be much more adverse situation for our group structure. I think bear in mind that REITs, where you've got a lot of subsidiaries like ours, you actually use that REIT structure to capitalize your subsidiaries in a different way. So now to go and turn that on its head would be I think it would really upset the apple cart. It would give Mr. Forster grey hairs. So it is really a great regime. We don't want to change it. We like being a REIT. I think people invest in us because we're a REIT, so we need to maintain that REIT status. And I think it's only beneficial. The cost is really marginal to not much. You need to be listed, so I guess it would be the listing fees.
And then we got two questions specifically on guidance for next year. I'm not sure if we can answer them, but just to ask them, please can you advise if you plan to conserve cash next year as well? And do you have an estimate of when the dividend will be resumed? And if so, is a normalized dividend of around 70 cents a reasonable number?
I don't know, 70 cents on what share? I mean, obviously the A has a minimum which will tick up. I mean, we are in a fortunate cash position at the moment, but the LTV is high. I think the market is uncertain. SA has got weak fundamentals, so we'll assess it, continually, but we are a REIT, so I think it goes without saying that we want to pay dividends out. That's kind of the nature of the investment, but we can't do that at the cost of the balance sheet and at the cost of the business.
Another question just on the specifics on net asset value. It's disclosed as R10.94. We can see FFA's NAV is down 46%, FFB up 6.8%. Could you explain briefly how that works?
Sure. So the NAV, given our share structure, has always been a bit complicated. In the past, it was disclosed as the NAV of the A was the 60-day VWAP and the B was the residual. That really came from the MOI. When we looked at it last year, the MOI really details 60-day VWAP in the event of winding up or liquidation. So, outside of a winding up liquidation type of event, the 60-day VWAP is largely irrelevant. In a going concern scenario, obviously the A's get preference to the distribution, and the B's get the residual, but rank pari passu in terms of most of the other provisions and in terms of any capital distribution. So we thought, well, let's rather just show NAV per share, which is the total NAV of Fortress divided by all the shares in issue. So that's the going concern NAV, and then we still do present the NAV just for comparative purposes. The A is on a 60-day VWAP, and given the price decline, that's what we're showing there at the end of June, and then the B's the residual.
On the cross-currency swaps, in the commentary it states that you've settled all the positions and notes, but there still is some reference to a position of 152 million euros. There's also a fair value liability of 664 million. Would you mind just explaining this a little bit and how the difference between closing the product and offsetting the product works? And just a final question on that is, have you completely removed exposure to these products?
Yes, so what we did is we were at 464 at December. In Jan, and actually we announced it because it was just before our results announcement in March, we closed about 162, and that was just closed, and we settled the mark-to-market. There wasn't that much at that stage. What we did was we saw the volatility in the pandemic, so we closed another 150 million euros, which was an outright close, settled the mark-to-market with the bank, and that was about 1850-ish, and then it kind of spiked up and it came back down, and we decided, well, let's rather look at just neutralizing it with an equal and opposite forward. So that's what we've done. So we've now got a cross-currency swap, which is essentially long the rand, and we've got a forward for the same amount and the same maturity date, which is short the rand, and that offsets each other. They both net settle, both settle around about April next year. I think the 664 is our total derivative position. So the derivatives, obviously our swaps, have moved out the money. So, that derivative, yes, there's the 664, there's an element of cross-currency, but there's also a big element of mark-to-market on our swaps.
Just moving on to the NEPI collar, could you please provide any more information that's possible? Could you provide possibly the strike price and the put and call levels? Any more detail on that?
Yeah, just given the capitalization issue, those will change, but the call strikes are around about 93.30, the put strikes around about 72.80, and we retain the dividends on the shares. That will be adjusted as SAFEX adjusts the capitalization issue.
And onto the BE partner companies, would you mind explaining just why 2 of the companies are consolidated and 2 are not at the moment? Ian?
So we had 4 entities, that's Fortress Empowerment 1 through 4. The 2 that are not consolidated, we've effectively sort of done deals on and are not exposed to the underlying movements in the Bs that sit there over the strike of 12 rand and 8 cents at which we concluded those transactions at. The other 2 are sort of ring-fenced and in waiting for a further transaction, and as a result we still consolidate them whilst not in our control.
And then maybe just a follow-up question, so technicality on the SA REIT. What makes up the difference between the 76 payout for REIT requirements and the 89% payout that was achieved on earnings?
Thanks. That's quite a sort of complicated question, but it's really the different methodologies applied in determining distributable earnings in REIT best practice, and that's it follows a methodology which is sort of capital employed on the basis that every rand is working all the time. One accrues, or the business accrues, for dividends to be received on our, in this case, Nepi Rockcastle share, almost on a day-to-day basis, and that matches when our dividend would be paid, whilst the JSE's definition of distributable profit follows that of taxable profit, and that looks backward over the financial period in what was actually received. So typically what forms part of our dividend, if we go back a year at June 19, would have been Nepi's dividends received by us in September and paid out in September with reference to the prior period, and that sort of follows on. So you've got a bit of a mismatch between the IFRS accounting and REIT best practice distribution methodology.
Question for Vuso. You mentioned that two retail assets were being sold. Which two assets were those again?
Protea Centre in Brixton, and Town Talk in Groblersdal.
Okay, great. And then just more thinking on the cross-currency swap closures, how do we plan to fund the Nepi stake? Is that through ZAR debt? And does that not create a bit of a dilution on the structure?
So the Nepi stake, I mean, from a funding liquidity perspective, has always been funded with the RAND debt. So we only have RAND loans from the bank. How we get to the synthetic euro debt is then we overlay a cross-currency swap. But that actually has no cash flow. It's literally just a derivative where we get, we receive 3-month JIBAR and we pay 3-month Euribor, more or less. So there's actually no cash flow required if you're looking at funding the Nepi stake. It is just closing that. There will be a bit of dilution, but as Ian touched on, the spread from 7.5, which did make it attractive in a stable market, we were earning 7.5% on that, on the RAND versus the JIBAR versus Euribor spread. Now that's reduced to 3.9 in a market that's a lot more volatile and a lot more RAND weakness. So it just didn't justify, the risk return just didn't work out for us.
And on Nepi, given your thoughts on Nepi's results in business in general, as well as your willingness to acquire well-priced or opportunistic assets, what's the possibility of potentially increasing the stake in Nepi?
Look, it is a big stake. I mean, I guess we'd need to look at that. It's a big stake. It's a great company. It's well capitalized. As we get through this crisis, I think, Joburg's had a kind of false start to spring. Wednesday was horrific weather, but it seems like the sun is out. The lockdown seems to be getting looser, and the COVID seems to be disappearing. So, we'll have to assess what we do with the capital resources that we have, I guess post sort of September, October this year.
You seem to have some good ideas to improve the industrial and office portfolio and the tenant relationships there. However, you do still say that it's a non-core asset. How are you balancing, that view of actively disposing it with, cultivating it and growing it?
Look, I mean, I guess it's almost one in the same. If you want to dispose of it, you do, or you get a better price, and it's quicker to dispose of if you've got a good story and nice assets that are well tenanted. So, it's sort of, I view it as one in the same strategy. We take Girton Road as an example for our offices. Fareed, who's head of that office team, spent what seemed like a fortune at the time. I think it was 5.5 or 7 million rand on plastering and painting, and refurbing a vacant office, which was just painful to do. and then on completion, we sold it to someone who wanted to undo what we had done and convert it to student housing. But had we not actually made the asset look attractive, I don't think we would have ever been able to sell 19 Girton. So I think we have to get these assets in a position to exit at a favorable price. So I think it's one and the same, but that's the strategy. So it's fix up where we need to fix up, re-tenant, reprofile to exit.
Another question for Vuso. The questionnaire said that he found your comments on retail trade encouraging, but would you mind just providing a little bit more detail on, pharmacy, supermarket, the performance of the subsectors that we're seeing in the market, and where who's doing well and who's doing a little bit worse?
I'm not going to go into the specifics of which tenants are doing well, but I'll just talk generally. I think, as I said, in totality, pharmacies in our portfolio are up 20%, 27%, sorry. The grocers are also up. I think the grocers are up about 6% in our portfolio. I'm not sure how much more detail I can give on that, but yeah, I think that should answer it. Howie.
Just another question, just on write-downs. Do you anticipate any further write-downs looking forward at the moment?
Look, I think same as last year, we would, just given our outlook on the market, be surprised if we were able to capitalize the interest and avoid a further impairment. So I think we probably see our land positions as the same value, at December and next year as they are now. But that would mean we'd capitalize the interest for IFRS, which is a requirement, and then probably write it down to the same value. So no, we don't, not in terms of, an actual write-down of where we are now. I think it's largely been taken, but, we are victim to the market. And if it does weaken substantially more, then we can't rule it out.
Just moving on to the AB structure, have there been any further discussions on the AB share structure at the moment?
No further discussions. As we came out and announced in March, April, just given the volatility in the stock market, in our guidance, we just said, it's sort of off for now.
Then there's just looking at operating expenses in retail and logistics portfolio, it seems to have increased a bit. What has been driving that?
The property operating expenses, as Ian touched on, that property expense ratio is really just an IFRS accounting. It's a bit of a matzah pudding, where you recognize the revenue on a discount, and then you recognize the debtor, and then the debtor gets written off through property expenses. So that really was a big driving factor. The other thing was R&M. We spent a lot more on the portfolio on R&M, and I think we, as we said in the past, if we are quite strict with that accounting, then we sort of don't. I think we need to get the accounting right, and then we actually call R&M, and we don't capitalize it. So that R&M line for the portfolio has doubled.
And one final question, just looking at the discount to NAV, does it not make sense to sell even more assets and use that to de-gear or buy back shares at the moment?
Yeah, look, I think, the share buyback, we did buy back a lot of Bs. That looks like a horrendous decision, 2020 hindsight. But, with your LTV at 38.5, we are selling assets. So if we were sitting at a hugely comfortable loan to value and we couldn't find anything else other than our own shares to buy, of course we'd look at that. That's always on the radar. It does make it complicated with our dual structure and the authorization we have from shareholders. We have to buy back 1A and 1B, 1A and 1B. So it is slightly more complicated for us.
Well, that's everything from the question side of things. Over to you for some final comments.
Thanks, Howie. I hope those were all questions from the market and none from you. No, that's it. Thanks, everyone. We look forward to more Teams and Zoom meetings with everyone next week. We'll hopefully catch up in person after the lockdown and certainly hopeful that March next year, when we see everyone again, it'll be a better market and a better time. So thank you. That's it from us.